Welcome to the new General Education by Wolf Academy, and this is going to be the first episode on the fundamentals of finance. I'm going to be explaining the most basic and most important concept in finance, which is the future value of money. So let's start off with an example. If this ping pong ball was actually a diamond, how much would it be worth tomorrow? And the answer is, I'll give you right away, you have no fucking idea. Okay, so let's go straight into the presentation. The future value of money, well, it seems like such a simple idea, right? Like, okay, I have $1 today, I have $1 tomorrow, I'll have $1 the next day. But what if I told you that the reality is that, tomorrow or the next day, you have no idea what your dollar is going to be worth. You're just crossing your fingers that, okay, maybe the government won't just fall out and all of a sudden your money won't be worth shit, or hopefully Elon Musk doesn't discover an asteroid and has like 1 billion diamonds on it, and now has 1 billion diamonds, so now your diamonds ain't worth shit. That's the truth, okay? So let me exploit this idea of the future value of money, differently than they teach you in school. I don't even know if they taught you this in school, but this is the most important thing in finance. Let's move along, okay? So the whole idea is that we don't know what the heck is going to happen in the future, okay? We know what's happening now. We know how much the dollar is worth now. We know how much a diamond is worth now, but we have no idea what's going to happen in the future. So the whole point here is we're going to try and calculate the value of time. There was a whole bunch of crazy talk there, which was all, necessary. I'm going to be showing you guys an equation that can explain it much simpler, but it's not really, to the point of what I'm trying to explain, but it's going to be to the most basic level of understanding the future value of money, okay? Welcome to the rock bottom of finance. Here's the most conventional wisdom level formula for understanding the future value of money using a variable called interest. On the very left, we have FV, which stands for the future value. Okay, what is the future value of your money going to be worth? Then we have equals PV, which PV is the present value times 1 plus R. And we have a 1 in there because, if R is a decimal to the nth power, then it can be smaller than what R is. So, we have to have a 1 in there to also add into the multiplication of the present value. So the present value actually matters in this equation. And what is R? Well, R is the interest rate. And what is N? N is the amount of periods. So you understand that interest rate is basically the percentage of return that you're going to get. And N, which is the periods, is the time value in this equation. Interest happens when you give someone your money, and in X amount of time they give you your money back plus more money, because what happened is that they're able to do something with the money you gave them, and because of time they're able to do some kind of magic and were able to make more money than you gave them, and they're able to pay you an interest for the money you gave them. And now I'm just showing you guys a different formula, but it's the same equation. It's just different variables that you can include to get the same value, okay? So you can just look at this and understand you're going to get the same thing. So now back to what's interesting, which is N, which can calculate time intervals in the formula. These are the most common ones. These are usually what's used depending on how many times you want to multiply the interest rate and how many times you plan on returning the investment. N is usually denoted by these constants. Now I'm showing you guys the present value formula. Before I showed you the future value formula, this is the same thing, just the variables are moved around in different places, and instead of R, it's I. We're finding the discount rate. It's the same number as the interest rate. We're just dividing it from the future value because we have to go backwards in time. We have to take out the interest that was accumulated to the present value, and that's how we find the present value. Remember, everything we're doing here is about time, so we're actually able to have a time variable in this equation. That's why it's somewhat relevant. Here's a great example of the present value formula. So imagine me and you today made a contract that in 2 years I would give you this $100 bill, but you're like, no bro, I want the $100 today. I'd be like, no bro, I'm not going to give you the $100 today because the bank is offering a 10% annual interest, and if I gave the money to the bank, I would accumulate more money than $100. So if you wanted the money today, I would have to factor in that the bank would offer me 10% in 2 years and subtract that from the $100, because you don't want to wait 2 years anymore, you want it today. So in 2 years, $100 would be worth less because I'd have more money than $100 if I gave it to the bank. I'd have like $121. So $100 in the future divided by the annual interest that the bank would give me for the 2-year period would end you up with $82.64. So if you wanted to end the contract from, instead of getting $100 in the future, I would give you $82.64 today, because $82.64 is what will be worth $100 in the future. Let's run this formula invertedly one more time. So in this scenario, pretend that you give this institution, the Pylon Gates, $20, okay? You give them $20 because this institution is promising 20% interest for 7 years. So what's going to happen to your $20 after the 7 years of 20% interest? Well, you're going to end up with $71.66 in total. And I said that so nonchalantly. A 20% annual interest for 7 years is absolutely ridiculously great. You know, if you can get a 3.5 times return in 7 years, that's to dream for. The federal funds interest rate for the past 10 years has been close to zero. That basically means your average commercial bank like TD Bank, Chase Bank, Wells Fargo, whatever bank you have your money in has pretty much a 0% annual interest. It's basically losing you money. You're not making any money, and other catalyst is actually devaluing money over time. So yeah, you're pretty much losing money by having your money in the bank. That's a quick history lesson. There was actually 1 year in 1980, 2 years about, where it was actually 20%, but that's not ever happening again anymore. It's slowly climbing up now because inflation is growing, but inflation and deflation and all those other terms are going to be for different video lessons to understand how that can calculate into the interest rate. Okay, so let's go back into next slide is showing you different interest time money formulas. This whole presentation has been around compound interest, which is your money is compounding over time. Then there's simple interest, which is basically, let's say you give the bank $100 and interest rate is 10%. So every year you'll get $10. It's not like compound interest it'll turn into 110, then 110 of 10% with 10% will be 121, then 10% times 121, blah, blah, blah. That's compound interest. Then there's continuous compound interest, which takes into account this variable e, which is a universal number. And if you go back to slide 4, you'll see that I taught you n time intervals. So with e, there is no time intervals, because now if you go back to slide 3 and you look at the second equation where it's r over n to the nt, if it was 1 over n to the n times 1, and you just kept raising n to a larger and larger number, you'd actually end up with the number e. So now this allows for this continuous compound interest effect where the interest rate is continuously compounding. And you'd usually find these equations when the interest rate is very, very small, and the bank would be like, hey, I'll give you continuous compound interest, okay? Now I'm going to show you a simple interest where in this situation, again, I give the bank $20 and the interest rate is 20% for 7 years, but instead of a compounding interest, the bank is offering a simple interest. So you can see I end up with $48. So I'm getting 20% of $20 every year for 7 years. And now this is showing you guys continuously compounding interest, the same numbers, and I end up with $81.10. Obviously, continuously compounding interest is better than both compound interest and simple interest. When there's different banks involved with different interest rates, you're going to compare the alternative interest rate as the bank, which is offering the best interest rate. So of course, you're going to go to the Pylon Gates instead of TD Bank because it's offering a much better annual interest rate. Since we're talking about interest rates, let me go ahead and teach you guys the federal funds interest rate and what exactly that is. So first off, there's this thing called the FOMC, which is this open market committee by the USA, and they're going to basically determine what the federal funds interest rate is going to be. Now, every currency basically has their own federal open market committee that determines what the interest rate is going to be for that currency. The Fed funds rate is the average interest rate of the economy. It's the benchmark of the economy's interest rate. The committee determines it by averaging the interest rates of all the other interest rates so you can get an actual estimation of what the interest rate of borrowing the dollar. This is at the highest level of borrowing money. Who cares about this most are banks and institutions, because there's this reserve requirement made by the Fed that they have to keep a specific amount of money compared to how much money their customers gave them, so that when the customer wants to withdraw the money, the bank has it. And when bank XYZ doesn't have the money to pay back the customer, bank XYZ is going to go to bank ABC or the Fed and loan money from them, and when they pay back that loan, they're going to also have to pay the Fed fund interest rate. Why is this important to know, and how can it be useful? So let me start off with some conventional wisdom. Of course, the formulas. The formulas are easy to follow. You plug in numbers, you get your result. Interest is a rental fee for borrowing money. And what happens when you give your money to the bank? Well, the bank can do anything they want to do with it to try and create interest, which it's funny because most banks don't even give you interest. The future value of money is what money will be worth in the future. Money can either gain value over time or lose value over time, therefore making the future value of money different than the present value of money. Now for the best part of this presentation, non-conventional wisdom. The future value of money doesn't actually exist until the present time is reached. That's because we don't know what's going to happen in the future that can affect the value of money. And that basically explains why marketplaces exist and price is changing all the time, because predicting the future is very valuable. Here are some examples of the unpredictable future. What's your dollar going to be any use if the apocalypse happens? And if Elon Musk starts mining asteroids and finds 1 trillion tons of diamonds, well, now the supply of diamonds is going to be so much larger, which means that there's going to be so many diamonds to sell that, of course, you're going to have to lower the price on the diamonds so people actually buy the large amount of diamonds there are. Here's a golden nugget. So if Brexit did not happen, the value of the pound would be much greater. That's because Britain being part of the EU would give them much more power, which would increase the value of the pound. Now let me break your brain by telling you the fact that units don't exist. They may exist in the present, but they certainly do not exist in the future. To understand it, imagine your diamond all of a sudden turns into a wooden pencil. Well, now you have a piece of wood. You don't have a diamond anymore, so you can't call it a diamond. If I went to Goldman Sachs right now and I was like, let me buy derivative contracts off of you that expire tomorrow with an underlying asset of diamonds turning into wood, and if it actually did somehow happen, I'd be able to sell it for a substantial amount. Goldman Sachs would love to sell me these contracts because obviously diamonds turning into wood is very, very unlikely. They would sell it to me for a very, 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 very cheap price, a super cheap price. Let's say 1/10 of a penny each contract, okay? Now take the same idea and let's move this derivative contract to expiring in 100 years from now. In 100 years from now, that's when the derivative contract would expire, which means that I have 100 years for my diamonds to turn into wood. Goldman Sachs would still probably think it's unlikely. They would still sell me the contract because, of course, they want to sell it and they're going to make money because anyways, what's the really likelihood of this happening? So the risk management team is going to be like, okay, let's take this risk. They're not going to sell it to me for 1/10 of a penny anymore. They're going to sell it to me for half a penny, right? Because now I have 100 years instead of 1 day for this to happen. Now I'm really taking finance to the extreme. I'm just really trying to show you how much variability you can have in the formulas that you can create. I showed you formulas in this video. Screw the formulas. We're trying to be creative here. I showed you this new diamond example of turning into wood with derivative contracts. Let's make a more realistic example, getting something we can actually take action on a little bit more. So back to the Elon Musk example of him discovering an asteroid with trillions of diamonds on it. Okay, so if that actually happened, the diamond value would obviously go very, very, very low. So in that case scenario, I can go to Goldman Sachs. I'd be like, hey, listen, let me buy a contract with you that expires in 1 year. Of diamonds value going from what it is now to I think diamond is going to be valued at $1 in 1 year. So they're going to be like, in their head, the risk management team again is going to be like, hell no, diamond's not going to be worth $1 in a year. So they're going to sell me these derivative contracts that expire in a year for, let's say, 1 penny. Okay, even cheaper. I can probably get 10 contracts for a penny. In this, it's realistic. I can actually calculate this. And then what I would do from here is hedge it. I would get another contract that expires in 10 years, and I'll pay a little bit more. The previous one I paid 1 penny for 5 contracts, and now I'm paying 1 penny for 1 contract. Okay, so I'm hedging it. I'm having a time hedge. I'm hedging the time, and it's called the spread. I'm spreading the time. And there you go. My prediction was right. Elon Musk discovered this asteroid, and my contracts are worth $100 each now, and I bought 10 million contracts, so I'm a billionaire. Just because I was able to buy the prediction of the future value of the price of diamonds. And Goldman Sachs insured each contract with 100 diamonds, so they owe me 100 diamonds per contract, and that's why this all makes sense. Emphasizing on the contracts that expire in 10 years are 10 times more expensive to buy. Emphasis also on the single variable that led to my success of Elon Musk discovering this asteroid. That is my interest. Okay, so interest in the formulas I showed you in this presentation was basically what was causing your money to accumulate more and more and more. In this scenario, Elon Musk discovering this asteroid is my interest.
In the next video, I'm going to be talking about stock market manipulation.